Good evening, ladies and gentlemen. You're watching Rush Hour with me, Sumita. Kareer. Over the next 30 minutes, we'll take you over the key and top stories that we're tracking right here on ET Now. So let's begin first with the big news coming in from China, as it has signaled further stimulus boost for next year. Now, amidst concerns of a slowdown in the Chinese economy, China has announced plans to pursue a moderately loose monetary policy, with fiscal policy being more proactive. Now, this is for the first time, remember, in 14 years that China has changed this monetary policy stance. This even as Beijing braces for a second trade war with Donald Trump when he assumes office next month. Remember, this also came in ahead of the annual Central Economic Work Conference in the coming days to set key targets and policy intentions for next year. Meanwhile, on the back of this news, stocks jumped and China's government bonds rallied. For more details on what this policy really entails, I'm now joined with my colleague Ashesha, who has more details on what these policy plans will include. Ashesha.
Well, yes, we had a whole host of macro data and policy announcements that came in from China today. First up, we had inflation data, where consumer price index shrank by about 0.8% on a month-on-month basis in the month of November versus expectations of about 0.4%. And apart from that, even producer price index shrank on a month-on-month basis, a little better than what the street was working with. Apart from inflation data, we also had a whole host of policy announcements that came in from China. Where they said that they will be announcing more policy measures and more fiscal measures in 2025. The language said was that it will be more proactive versus the word proactive used earlier. And experts are also very positive as far as the announcements are concerned. In fact, experts say that the measures that have been announced point to fiscal expansion, big rate cuts and asset buying that will be done over the next few months. Additional policy tools are expected to have significant improvement in volume, quality and effect. So experts are very positive with the kind of announcements that have come in on China today. Now, apart from this, there are also reports which suggest that Chinese President Xi Jinping and other leaders will be meeting this week to discuss economic policies and growth target for the year ahead. So all eyes will also be on that policy. But all in all, inflation data was okay. But the big announcement that came in with respect to fiscal policies for 2025 is a big positive.
All right, thank you very much, Ashesha, for filling us in on those big announcements. And of course, to discuss this further, I'm now joined by a live guest who's joining us, Geoff Dennis, independent emerging markets commentator. Thank you very much, Geoff, for joining us this evening on ET Now. Now, Chinese leaders have signaled at more stimulus for next year. There have been a slew of other measures too in the past. But Geoff, the big challenge for China continues to be a consumption boost. With these recent new announcements, do you anticipate a meaningful impact?
I frankly am pretty unimpressed by this, because all you're getting here is more rhetoric from the Chinese. They're announcing, apparently a dramatic statement that they're going for a prudent monetary policy to moderately loose. I have two issues with that. Number one, what are they actually going to do? What does that translate into in terms of monetary policy? Secondly, monetary policy easing has occurred over the last several months with no impact obvious impact on the economy. So that's point number one. Point number two, they're promising fiscal action, but we don't know what they're going to do. And we need to know the details. We need to put those policy changes in place, because frankly, it's fiscal expansion that the Chinese economy needs. So it's rhetoric right now. We're not getting any details until March. And the Chinese have developed a habit of over-promising and under-delivering on some of these policy measures. So I'm not impressed particularly by this. I need to wait and see the details.
So we'll focus a bit more on what you've mentioned and why you're not really impressed, and what more does China really need to do to sort of boost consumption and, of course, the lagging sectors in its economy. But when I said that, will it lead to a meaningful impact? That is because you also have Trump threat looming large as well, which could perhaps derail the growth process in the country.
Agreed. And this is why I think there's a greater urgency for the Chinese authorities to act now, or at least rather faster than the 3-month window that they've given themselves. I mean, this is sort of typical of the way the Chinese do this. It's all a process. It's a prolonged process. And while they're going to set out their goals and targets for 2025 at this current Politburo meeting, we need to see actual the fiscal side, particularly lower taxes and lower taxes on consumers, and also real attempts to try to deal more successfully with the property sector, which still remains very weak. Meanwhile, as you rightly say, there is the overhang of the tariff policies potentially coming in under President Trump when he's inaugurated in mid-January. Again, we don't know exactly what Trump is going to do. We have to wait and see. But I think the market today, the Hong Kong market and the Hong Kong China Enterprise Index market, by rallying between 2.5% and 3%, I think is overreacted. The local market, the Shanghai Composite, did nothing, and I think that tells you foreigners are more excited about this than the domestic investors, and I remain unimpressed. I want more details, and of course, as you say, there's the tariff overhang still to come.
Absolutely, and we'll have to see the kind of impact that has really on these kind of stimulus measures that China is going to announce and has, of course, announced till now. But Geoff, on the India point, we've seen FII selling in the past few weeks post the initial set of fiscal support measures came in from China. Do you anticipate further FII selling to China, and then how does that really change the overall market setup right here in India?
Well, I think clearly India's hit a bit of a wall in terms of the market performance, as you rightly say, and you'll know this better than me. You've seen some significant FII selling. My call all along has been to kind of favor India at the margin over China. And I haven't got this one entirely wrong, because I don't think you've really seen a sustained rally in China. You've seen big pops and then it's come back again. You've got a big pop today and it's going to probably come back again. Whereas I think with India, the challenge to its long-term performance here, the long-term performance of the Indian market, is going to be more what happens in the domestic economy, where obviously that more recent GDP number, or that recent GDP number, was a bit of a negative surprise. Yes. So I think what foreign investors need to know to get back into India is not necessarily what China's going to do there. We're going to have to wait a while for that, but they really need to know, is this economy in India slowing sharply, and does that reduce the attractiveness of the Indian stock market? For me, I've for many, many months now favored India over China. It hasn't been a particularly good call in the last couple of months, but I would stick to that on the assumption that the Indian economy is going to continue to grow quite well and is going to grow more rapidly than the Chinese economy, where we continue to await real measures that will stimulate the economy as opposed to a lot of talk.
Absolutely, Geoff, and that's also been the word that we've heard from government officials right here. In fact, analysts also stating that perhaps, this blip that we've seen in Q2 of the GDP for India, that will correct itself, and of course we will see the economy bounce back on the back of good rainfall, and of course there will be a capex stimulus that will be employed by government as well. But let me ask you, amidst if you really talk about the broader setup, global setup, there is an expected boost for the US markets post Trump's comeback, and now China. Which sectors do you really suggest for investors to look out for, and which markets are currently looking relatively attractive to you at this point in time?
Well, let me answer the second question first. I mean, I posted something about a week ago which said America first means emerging markets last. And unfortunately, the policy framework that is probably going to develop under President Trump when he takes office will, I think, be tough for emerging markets, because logically it means that the dollar is going to stay strong, possibly strengthen further. I do believe bond yields will rise further, having pulled back a little bit recently, will rise again because of all the fiscal expansion that Trump is promising. And so I think it's still going to be quite hard to get people really to put a lot of money to work in the emerging markets over the next several months, unless Trump comes in and does something completely different. I mean, as of this moment, emerging markets are underperforming developed markets in 2024 by 1,300 basis points. It's a big underperformance, probably one of the widest of the year. So I think people are going to continue to be very wary about investing across the board in emerging markets. Now, what would I like? I think you've got to continue to look at oil, not least because of the latest uncertainty created by the collapse of the Assad regime in Syria, which is pushing oil prices up today. In terms of India, I've long thought you've got to be invested in the banks, also technology, and also to a certain extent pharma. I think a broader consumer portfolio would really require a little bit more confidence that obviously you've expressed just then, that the Indian economy will rebound. And if investors see that, I think they'll start to rotate some money towards consumer. But my general point right now is I don't think this is a great environment for emerging market investing because of what's going to happen in the US, over the next several months in terms of new policies from the Trump administration.
Absolutely, Geoff. So you remain bullish on India, but of course, there is some caution building up so far as emerging markets are concerned. And of course, that is on the back of the kind of developments that we'll see in the Trump regime. On that note, thank you very much, Geoff, for joining us this evening on ET Now. And ladies and gentlemen, it's time for us to slip into a quick break, but lots more coming up on the other side.
If you like this video, then like, share and subscribe to ET Now.